Okay, I think we can start. Welcome everyone to today's webinar. We're looking at electric vehicle analysis. Today's webinar is hosted by Green Economy London, and we are partnered with Tepperman's, and their amazing sustainability coordinator, Mike, will be our featured speaker today. A little bit of housekeeping. I just wanted to let people know if you guys have questions throughout the presentation, please just add them to the chat box and we'll address those during question periods. So I will just do a quick overview of Green Economy London, and then I will introduce our speaker, and then we'll get right into it. So hello everyone, in case you aren't sure who I am, my name is Natalie Merchant, and I am the Hub Manager at Green Economy London. Green Economy London is a program run through the London Environmental Network, which is a non-profit organization in London that aims to cultivate a healthier, more sustainable city. Our vision is to have London be known as one of the greenest and most resilient cities in Canada. Our mission is to build participation, collaboration, and capacity in our community to co-create positive environmental change. So we run a variety of different programs. Today's program, Green Economy London, is the one that's helping host this webinar for you. Green Economy London is part of a network of hubs that belong to a national nonprofit, Green Economy Canada. So all these hubs work to build sustainability, participation in businesses, get them to set goals in greenhouse gas emissions and water, waste, and all the areas of sustainability. These are just some of our founding partners and sponsors that make events like this possible. And I just wanted to give a quick shout out to all of our amazing businesses that are currently participating in our program. We have over 42 businesses that are doing the Green Economy London program. So we're very excited to have all these businesses participating and setting sustainability goals. And so I just wanted to quickly say, if you guys want to learn more about Green Economy London, if you want to make sure you're not missing out on events like this, please connect with any of our social media or check out our website, or please feel free to email me. I did want to give a quick shout out to anybody here today that is thinking about installing an EV charger at your workplace. There is current federal funding that will be available soon this summer to get 50% off level 2 chargers that's for commercial buildings, multi-residential, and public spaces. Green Economy Canada will be running that program, distributing that funding. There are also some other organizations I can connect you with that have that funding, so please email me if you want to learn more about that. And I can connect you to the right organization that can help you with that. So without ado, I wanted to introduce our amazing speaker, Mike Apostol. He is the sustainability coordinator at Tepperman's, which is a furniture, appliance, and electronics retail store that has 6 locations in southwestern Ontario. So after 12 years as a mechanical engineer, he went back to school in 2019 to get his Master's of Environment and Sustainability from Western, with the goal of helping businesses lower their environmental impact from their operations and products and directly address climate change through carbon emission reduction strategies. Mike combines his years of experience as an engineer and project manager with the knowledge gained from the MES program to provide cost-effective solutions that can help businesses achieve these goals. So I'm going to turn it over to you, Mike. So I'll stop sharing.
All right, thank you for the introduction, Natalie. Let me just get my screen shared. All right. And we're good for sharing?
Okay. We're good.
All right, awesome. So again, I'll be talking about electric vehicles today and kind of the business cases for them. Natalie just did a great job of introducing me, so I won't recap that again. But what I'm going to be talking about is kind of the overview of electric vehicles. So just some general points about them, how I went about doing the financial analysis and kind of the method that I used. And it's important to understand that just so you can sort of see how I get to my conclusions. Then I'll actually talk about a couple of business cases that we looked at Tepperman's. And you know, they're general cases though that can be used for anyone. I'll briefly just talk about the spreadsheet tool that I made to do that analysis. And then if there's time, there's some additional information that I can talk about as well. So let's just quickly run through some of the basic points about electric vehicles and why kind of they're going to be the future and why I like them so much. So how they work. So if you look at a traditional gas vehicle, it uses gas and an internal combustion engine to convert fossil fuel energy into vehicle motion. In order to do that, it takes more than 2,000 moving parts when you have the engine plus the transmission, and basically the maximum efficiency you can get is about 40%. Most cars are in the 35 to 40% efficiency range these days. So that's per amount of energy in the gas to moving vehicle, maximum 40%. Electric vehicles kind of are this leap of technology. So they use batteries and an electric motor to convert stored electrical energy in those batteries into vehicle motion. And what's really cool about that is that they can do this with less than 20 moving parts, and you achieve better than 85% total efficiency. So your just use of energy is so much greater with electric vehicles, as well as the simplicity behind them. One of the nice things about not having a large internal combustion engine is that you get improved safety. So because there's no gas engine, you have this much larger frontal collision crumple zone. So you're a lot safer in an impact. Additionally, because all the batteries are placed at the bottom of the vehicle, you have a lower center of gravity. So you end up getting better handling with the vehicle, and you have a much reduced chance of rollover in some sort of accident. And of course, there's no gas, so there's actually a much lower risk of collision fire hazards. And we'll talk a little bit about that at the end potentially, but EVs do not go on fire nearly as much as gas vehicles do. So due to that kind of higher efficiency, you obviously are going to see some operational cost savings. So your fuel savings, EVs use electricity, and gas vehicles obviously use gasoline. So if you look at the kind of per 1,000 kilometer cost, you're 78% cheaper with an EV versus a equivalent gas vehicle. Obviously, these are subject to a bit of variation depending on your EV and your gas vehicle, et cetera, but that's kind of a nice rule of thumb there. Your maintenance cost per kilometer is also lower. So again, there's so many fewer moving parts to actually fail. And then on top of that, you're not doing oil changes or transmission fuel changes. So you end up with this kind of average cost that's actually quite a bit lower than the gas vehicles. And the environmental impact is kind of what a lot of us care about. Obviously, the one big overarching way to look at this is looking at the total life cycle greenhouse gas emissions. So if your vehicle is going to last you 150,000 kilometers, once you account for emissions at the tailpipe, the production of energy or fuel, the manufacturing of the vehicle, and then the manufacturing of the batteries, you still end up getting greenhouse gas emissions that are 73% less per kilometer with the EV than the gas vehicle. Operational greenhouse gas emissions. So this is more what people care about when they're doing their greenhouse gas inventory. So an EV will have 64 kilograms of CO2 equivalent per 10,000 kilometers charged with electricity. So that's kind of like a scope 2 emission. And then a gas would emit 1.8 tons of CO2 over that same 10,000 kilometers. So it's a pretty drastic reduction in operational emissions. I've used Ontario's energy grid for these calculations. If you live in Alberta, they're going to look very different. But since we're all in Ontario, I believe, this is kind of the numbers I'm choosing to show. And tailpipe emissions. So an EV has no tailpipe. It's just electrons flowing around inside the vehicle. So there's none. While a gas engine vehicle has lots of emissions, and a lot of them very hazardous, different types. Automakers have done a pretty good job of the last decade or so reducing the amount of emissions, but they're still there and they're still plentiful. So just to kind of give you a state of the industry in terms of what can you get range-wise for cost in 2021. And these are just kind of average numbers. So your typical entry-ish level EV will get you $350,000 to to 400 kilometer range and cost between $45,000 and $50,000. Your long range 2021 EVs, if your use case needs that, you can get between 450 to 570 kilometers, and you're looking, $65,000 to $80,000. And the longest range EV that I could find was the Tesla Model S, and that has 663 kilometer range. And it's obviously very expensive as a premium vehicle, but it kind of gives you a perspective on how far range has come over the past 5 years with electric vehicles. Charging is another aspect of EVs that is important to understand. So there's sort of 3 types of charging. If you take your EV and you just plug it into a standard 120 volt outlet in your house, time to full charge will be 20 hours, and really charging speed is kind of what makes sense. So you'll charge your vehicle 7 to 10 kilometers per hour of charging. Level 2, you can get some of those, you can get those in your home. That's sort of your dryer outlet, your 30 amp service. And you can charge anywhere between 30 to 70 kilometers per hour, depending on your max current draw and voltage and all that stuff. And a lot of businesses use level 2 chargers at their sites. And then you have fast chargers. This is like the Tesla supercharger network that they have. So fast these days. And some of the newer ones coming out, again, also extremely fast at 140 to 300 kilometers if you're charging just for 30 minutes. So they've really improved that kind of range anxiety where, you're gonna have to stop mid-trip and actually, charge for 2 hours or something. It's not really the case anymore with fast charging. And if you're wondering kind of what's available, so this is just from PlugShare. I just did a quick screenshot of Southwestern Ontario, and it shows all the available public chargers, and the orange ones are your kind of high power fast chargers. So there is an abundance of chargers available out there. So, that range anxiety that we continue to hear about really is not too much of a concern anymore. Okay. So let's get into how I do my financial analysis. Very fun, I swear. All right, so a lot of people use simple payback. And what that is basically your initial vehicle cost divided by your yearly operational savings. So let's say you bought a vehicle for $50,000. You're going to save $5,000 from operational savings. Your simple payback is 10 years. You go, 10 years? Oh, I'm never going to do that. And a lot of purchasing decisions are made using this method, but it's not really the full story or that accurate, and misses a whole lot of stuff that's important making the business cases for electric vehicles. So the net present value is a formula that is a better method of actually doing business cases. It allows you to account for impacts from taxes. It defines a timeline for how long you're actually going to own the vehicle. Most businesses will buy a vehicle for 3 years and then sell it, just to stay current and not have to worry about, extended maintenance costs, et cetera. And it can be used for any type of capital purchase. I'm focusing mainly on vehicles, so you'll see vehicle in all my, net present value analysis stuff. But you can use this for everything, and it's a really great tool and formula. It allows you to compare different options directly or against a company's expected rate of return for a new project through what's called the discount rate. I'll touch on it in a little bit. If you don't understand it though, don't worry about it too much. Anyway, so let's run through kind of the sections of the formula. So your initial vehicle cost, obviously just the cost to purchase the vehicle. The tax deductions from this will come later in the formula in 2 slides. So let's just hold off on that right now. Very straightforward. Cost to purchase vehicle, you put that at the start. Your yearly cash flow is the sum of the yearly expenses and revenues for however many years you plan to keep the vehicle. So every year you're going to have cost of fuel, insurance, et cetera. And so you add all those up, and that goes in this section of the formula. So again, those examples, insurance, fuel, maintenance, If you're a really progressive company and you have a cost of carbon, you can put that in there as a cash flow. And thing to keep in mind is that expenses are tax deductible while revenues are taxable. For buying an electric vehicle, I doubt you're ever going to have revenues from it, but if this were a solar project analysis, you would get revenues and you would be taxed on it. Depreciation of the vehicle. So this is a tax deduction that allows a business to claim the loss in value of a capital asset due to wear and tear or obsolescence. It's defined by the government through the capital cost allowance rate. And basically all it's saying is a business bought this expensive item for their operations, and the government defines how you can write that off as a tax deduction over the coming years. The CCA rate is, because it's defined by the government, they can use it to incentivize certain things or not. And it's important to understand that because it directly affects your electric vehicle analysis. So your capital cost allowance for electric vehicles is 100% up to $55,000 in the first year. What that means is you bought an electric vehicle in year one, you can deduct up to $55,000 completely. So you get that tax write-off right at the start of the project. Where if you were to buy a gas vehicle, you can only deduct up to 30% per year and up to a maximum of $30,000 value of the vehicle. So you can see there, the government sort of incentivized and provided a better tax break for electric vehicles. And the last thing is just sale of the vehicle. So it's your expected income when you sell the vehicle after a specified number of years. Your income from that is taxable, and in the formula, you'll see it's referred to as salvage. So if you have the vehicle for 3 years, you sell it in year 4, that's where this value comes in. You have to guess what your sale price is going to be. So my typical assumption is vehicles lose 15% of their value per year. Certain EV brands appear to be doing better, and gas vehicles will likely do worse in the coming years. You should really try and make this as accurate as possible by doing kind of market research, and you can find stuff online about how much vehicles are worth after however long you're going to be owning them. All right, so the discount rate, I alluded to this earlier. So this affects all the parts of the formula that happen in future years. And what the discount rate is it allows you to compare your project against an expected internal rate of return for a project. What this means is, say you have an option to either buy some sort of equipment like a electric vehicle or invest that in a mutual fund, like as a company. You have those two choices. And the mutual fund will for sure give you 8% back. So you say, okay, well, will this vehicle that we're going to buy give us better than 8%? So you put in this 8% as your discount rate, you do your formula, and if the net present value ends up being greater than 0, then you're getting better than 8% return, in which case, yeah, definitely do this. When you're buying a vehicle for businesses, generally you have to buy a vehicle. It's not really like an option, I guess. So, but you can still incorporate essentially the cost of debt financing, and that allows you to just derate future income or expenses against kind of your cost of debt. So again, it just sort of converts money from future years into present day dollars that allows you to do a bit better analysis. Just keep in mind, it's not inflation, kind of gets confused for that, but it's not. This is the actual formula. So I keep it text-based. I initially had just the formula up and then was walking through it and showed that to my wife and she yelled at me. So I've just changed it to nice text stuff, but this is what's happening in the background. Your lambdas are your taxes, your R's are your discount rates, years, and you kind of see how it sort of just chunks out there. But that's it. It kind of looks scary, but it's really not. And again, in the spreadsheet tool that we'll be sending you guys, it's all just coded in the background. Okay, so let's take a look at the first business case. And this is employee reimbursement versus having a shared company EV that employees can use instead. So this is something we do at Tepperman's. The numbers here are kind of just generalized for any sort of mid-sized business. So, this might apply to you. And then the way I'll chunk it out will actually just be, even if you don't come anywhere close to these values, you can still see how it's applicable. So let's say you reimburse your employees 49 cents per kilometer that they drive for work purposes between sites or whatever. You did a survey of all your employees and you find out that they actually drive around 200,000 kilometers per year by all the employees. You deep dive into that data, you find that you have 10 high mileage employees that altogether drive about 120,000 kilometers. You have one guy that's just driving all the time. He's doing 45,000 kilometers a year. And then you have, everyone else that's just sort of aggregate to 35,000 kilometers per year. We're looking at how they're using or how they're driving. 300 kilometer range seems to be what's required. And for the sake of argument, I'm going to say chargers are already available at kind of the workplaces that we're going to ignore the cost of installing a new charger in this business case. Conveniently for Tepperman's, we actually have chargers at every one of our locations. So this sort of applies directly to us as well. So that reimbursement cost of 49 cents a kilometer comes out to about $98,000 a year that you're paying to do this. Environmental impact, 41 tons of CO2, using kind of an average liters per 100 kilometer emission rate. So does it make sense to switch to a shared company electric vehicle? So let's just plug stuff into our net present value formula and see what happens. So we're going to go to kind of the smallest chunk, I guess, of usage and just say, let's do the analysis for one vehicle being used 35,000 kilometers a year. Because we're a business, we're only going to own the vehicle for 3 years, sell in year 4. Discount rate, 2.3%. That's what I'm going to use. And then your standard corporate tax rate of 26.5%. So because of that 300 kilometer range, accounting for some winter reduction, the one that makes sense for this case is the $65,000 Tesla Model 3 long range. So that's the initial cost that we're going to look at. And then your cash flow comparison is going to be EV expenses, which is electricity, maintenance, and insurance, versus the reimbursement cost, which is just your 49 cents per kilometer over the 35,000 kilometers. So if we put that into my lovely text-based formula for net present value, initial capital cost, like we just talked about, your sum of the yearly cash flows. So it ends up costing $7,000 for the EV over 3 years, $36,000 for the employee reimbursement. I know they might seem low initially, but keep in mind this is after tax impacts and the discount rate. And I've just rounded everything just to help it make sense. It'll be a bit easier to read. Depreciation, so this is the capital cost allowance defined by the government. So you get $16,000 back as a tax write-off. And obviously you're not going to be getting that for reimbursing your employees. And then you sell the vehicle at the end of 3 years, and so you get $24,000 back and nothing for reimbursing employees. So your total 3-year cost ends up being $32,000 for the EV, or costing you $36,000 for reimbursing your employees. So in this case, getting a shared company EV that employees can use ends up saving you about $1,300 a year if it gets used for 3,500 kilometers or 35,000 kilometers a year. But what's the impact from changing the kilometers driven per year? This is kind of a sensitivity analysis that's pretty easy to do. So if we only drove that EV 25,000 kilometers a year, all of a sudden it's actually going to start costing us a bit more money. There's the $35,000. And then the more you drive that EV, the more savings you're going to see per year. And you can sort of see that the break-even point is around 30,000 kilometers per year. So in this scenario where we have 200,000 kilometers driven, what would be my final recommendations? So get 2 EVs shared by the high and low mileage employees. So assume, again, this would be based on user data. You get 2 EVs, one of them based on the usage that you've seen is going to get used for 55,000 kilometers. The other one's going to get used for 35,000 kilometers. And you can kind of see your savings per year there for each. And for that one guy that's driving 45,000 kilometers, get him an EV directly. And let him use that instead of reimbursing him for, or her, reimbursing them for the kilometers driven, because that will save you $4,500 per year. Obviously, this doesn't add up to 200,000, but when you're talking about a shared vehicle or shared vehicles for employees to use, there's likely going to be scheduling issues. So these are kind of just approximate numbers for usage, and that remaining 65,000 kilometers likely would not, you just wouldn't be able to get that high amount of usage out of it. So your total savings in this scenario is $13,500, and you save 27 tons of carbon dioxide per year. Also, there's always co-benefits to going to an EV, like we talked about: your increased safety, improved public image if you decide to brand your EV with your company logo, and decreasing the air pollution. All great things. So that's the first business case, just versus a reimbursement scenario. And now let's take a look at one that I recently did for Tepperman to compare a gas option versus an EV option for our service tech vehicles. So right now we have 6 service technicians that drive around, do furniture repair in the company-owned gas vehicles. We need to buy a new one soon. So the question is, what do we buy? So we know, based on the data analysis data that we have, 2 of them get driven 38,000 kilometers per year. From the last example, it kind of shows that the more the EVs are driven, the more profitable they become. So I'm going to look at replacing one of those with an EV versus one of the other ones that don't get used as much. They're obviously just used for regional day trips only, and the max kilometers they ever drive is about 350 kilometers. Greenhouse gas impact from one of these vehicles is about 9.2 tons of CO2e. So let's take a look at the net present value. So again, same as before, time frame 3 years, usage 38,000 kilometers per year this time, standard discount rate and corporate tax rate. And I want to see if the Tesla Model Y long range for $70,000 will work out better. And the reason I chose that is because when looking at how we utilize these larger mini cargo vans, we actually don't need all that space. If you took a Tesla Model Y, folded the back seats flat, and combined with the front trunk that they have, we'd easily be able to have all the repair equipment required, plus whatever they're taking to sites. So this is kind of the proposal. So again, your net present value formula looks kind of like this. So your initial capital costs, your sum of your yearly cash flows. You can kind of see the discrepancy between electricity costs versus gas costs, and obviously the difference in maintenance. Your depreciation, again, you're getting that full $55,000 of tax write-off in year 1 versus the $30,000 for the gas vehicle. And then you sell the vehicle at the end of life, or year 4, let's say, and your total 3-year costs, unfortunately, for the EV ends up being $35,000, where for the gas vehicle, it's $27,500. So the EV is actually more expensive by $2,500 if it gets used for 38,000 kilometers per year. I don't really have the option of increasing the usage because this is just hard data. They don't drive more than this. And it's unfortunate in this case that it didn't quite work out as hoped. But what would I recommend? I'd still say get an EV as a pilot project, as an environmentalist. Use the co-benefits to justify the incremental cost, and then wait until the prices come down to make it viable financially. So you're spending a little bit more, but you're getting those co-benefits out of it, and you're reducing your greenhouse gas emissions. So the question kind of then comes up, let's look at the sensitivity analysis and what could have made this work out for the EV option. And each one of these that I'm going to show is inclusive to themselves. They don't stack. So if the EV cost was $57,000 instead of $70,000, the EV would have made more sense. So you can kind of see where that price needs to drop down to in order to make the business case for this. Another interesting way of looking at this is if the EV cost was $61,000 and you were a very progressive company and you had an internal cost of carbon of $150 per ton of CO2, then the EV would have made sense. And this is kind of cool because you can start to see that as businesses start to incorporate an internal cost of carbon, it will actually start to affect the business cases and the choices they make. If the EV loss of value was only 11% per year instead of that 15%, like the gas vehicle, and like I kind of do as the main assumption for kind of your sale price, then it would have made sense to get the EV as well. So it has a big impact on the resale price. So it's kind of important to dial that in as well as you can. I know a number of the people on this call are probably from nonprofits. So if you actually paid 0% tax and had a 0% discount rate, then the EV would have made more sense as well, just due to the operational savings that you get. So doing your own analysis.
Mike, sorry, I just wanted to address a couple questions on that last business
Sure.
case before we move forward. Maybe it'll just help you answer those while they're relevant.
Sure.
We did have a question. Do you expect EV owners to pay some sort of road tax to replace the gasoline tax that they would no longer be paying for road maintenance, transit subsidies, etc.? Like, do you think that will be something?
Yeah, I hope it won't be. It's more of a publicity thing, I think, than anything else. You'll see certain places in the US are starting to incorporate that. Likely for Ontario, I don't see that happening. I think we'll get the tax revenues that are lost from the gasoline tax through other avenues, such as the carbon tax that they're doing.
Great. And I also had a question here from Tyler. He asked, how does that change if you add a price for carbon? So I'm not sure exactly what he was referencing there. Do you know what it means? Yeah. Okay.
Yeah,
oh,
absolutely.
You already answered it. Sorry.
Yeah. So this is that 150 ton of dollars per ton of carbon. So that's where you kind of see that jump from 57,000 to 61,000.
Lovely. All right. Sorry, I missed that part. And then there's just one more question. How do you account for the brand value of supporting a GHG reduction? So I guess that's kind of interpretive. But.
Yeah. So, I mean, that's sort of the co-benefits. I think that's what you're asking, the improved public image.
Yeah.
That's a discussion between you, your marketing, and your executive team. If you want to apply a dollar value to it, or you just say, okay, hey, that's totally worth, in this case, $25,000 a year to justify this financially. I mean, I'm not about to give you numbers for that. That's a tough go. But yeah, there is something there for sure. And based on what we're seeing, and at least at Tepperman's, a brand sustainability image is starting to really impact their customers. So the more sustainable a company is, the more the customers really like that brand.
Amazing. That's all the questions so far. So if you want to continue on, great.
Sure. Okay, so again, all this stuff I've encoded into an Excel spreadsheet. It allows you to kind of compare between electric vehicles, internal combustion engines, hybrids, and that employee reimbursement model that I started with. It looks complicated. It's really not, but there's two sheets. So this is the first sheet in it. You get to put your mileage, your discount rate, tax rate, number of years you're going to have vehicle, and then your initial cost of the vehicles. And then you get kind of your summary up here. And if you really want to deep dive into all the different cash flows and that sort of stuff, you can, and your greenhouse gas emissions are down at the bottom. And all those other little variables are on the second sheet, mainly this top part here, variables 1 and 2. And this is where you get to play with stuff like your liters per 100 kilometers for the internal combustion engine vehicles. You know, how efficient is the electric vehicle that you're looking at? Your maintenance, if say for, I don't know, some electric vehicle, you're actually seeing that it's closer to 3 cents per kilometer for maintenance. Or based on data, you know, gasoline or electric vehicles really have very little maintenance in the first 3 years. So you're going to completely, you know, put that down to almost nothing, right? You can play with kind of all these things. And then to the other person's question, you can also throw in the cost per ton of carbon emissions. So if you want, it'll automatically calculate that out too and incorporate it into your cash flows. Everything below the variables is more just, I like seeing the operating cost breakdown, just because I like seeing the data. You can more or less ignore this stuff, but it's kind of interesting, and it lets you quickly see the impacts of changing the kilometers per year, and doing that. And changing this little green cell up the top for kilometers driven per year only affects this page, where these variables will affect both sheets. So that's that. So final thoughts on the business cases. EVs seem expensive, but the operational expenses are much lower as compared to gas. Usage, how much you're going to use the vehicle, kilometers driven per year, and the resale of that, you know, more expensive vehicle play a large role in the business case. So it's important to try and dial those in. Every business case is unique. Obviously, you need to adjust it based on the data you have for your business, or, you know, if you're looking at this for yourself, consider those important factors. There's great co-benefits, as we've discussed. That spreadsheet that I just talked about, we're going to be sending that out to everyone, and, you know, feel free to contact me if you have any questions about it or this presentation, or want any help with your analysis. I mean, I switched into this career from being a mechanical engineer to try and help as many businesses as possible and as many people as possible reduce their greenhouse gas emissions. So I'm always happy to help in any way possible. Did we have any questions at this point?
I don't think we had any new ones in the chat. If anyone wants to just pop on their mic, feel free to ask a question live.
If not, I've got a couple more slides I can go through that we can do pretty quickly.
Yep, if anyone has a question that pops up, just put it in the chat in the next couple minutes and we can try to address those too, but let's keep going. Okay.
All right, so you'll notice I chose 2 Teslas for each of my scenarios. I find they have the best value for range. They've been around kind of the longest and improving their drivetrain, batteries, and engineering. So I like them from that aspect. They're rated very high on safety. They've always prioritized that. Their driving assist and safety stuff is continuously improving with over-the-air updates. And the other cool part about it, Tesla specifically, and I think some of the other manufacturers are coming on board with it, is that you can have a digital key that's shared with an app. And so if you're getting a vehicle that's going to be shared by employees, that makes life a lot easier versus a physical key. Yeah, and there just weren't a lot of competitors with the range or efficiency for the business cases that I was looking at with Tepperman's.
Hey, Mike.
Yeah.
It's Marianne. I have a question just in regard to your Tesla choice. Did you look at any cube vans or anything that was larger? And did you find any good products that you could share some information about?
Yeah, so the larger vans, so cube trucks specifically are still very expensive to electrify. They don't really make much sense at this point. I believe the Volvo one I was looking at with a 32-foot long kind of cube truck, you know, it's $450,000. Like it's well beyond the business cases for most people. Like, yes, you can go out on a limb and spend that much more money, or you can just wait until they kind of come down in price in another year or two. I think
Was there any, I think there's a couple minivans on the market. Did you look into them at all?
Fully electric with long range.
I guess I don't know about the range of the minivans. I suppose that's what I'm asking.
Yeah,
but I know there's a Mitsubishi product.
Yeah, there's a few in-city electric vehicles for delivery.
Okay.
But they didn't up for the specific kind of longer range business cases that I was doing. Some stuff is out there. Generally, they're still, for when you're getting into kind of that commercial side, they're still very expensive and hard to really justify without pretty significant rebates on them. And again, that's one of the things we're hoping that mini cube van that we're using, or that mini transport vehicle, is going to actually be electrified at some point soon. I know Ford has announced that they plan on releasing some kind of delivery van style vehicles. We'll see what happens and what price they come in at. I won't know until kind of that's released later this year, I believe. But it's still very early days. There's not a lot of people doing that commercial transport side of things. And again, there's just nothing, there's not a lot in the Canadian market right now.
Okay, thank you.
Yep, no problem. Battery degradation. So I'm just going to go through a couple other, not myths, but just information about it for things that people might be concerned about. Battery degradation was mostly an issue with some early EVs. Generally, your average loss is about 2.3% per year now across most of the modern day EVs in the past 3 years, let's say. So with an EV with 350-kilometer range, it's about 40 kilometers of lost range after 5 years of use. Something to consider, but don't let the fear of that really impact your choices. Flammability concern. I kind of alluded to this earlier. There's a perception that EVs catch fire all the time. It's, again, the data doesn't really support it. So if you look at kind of US average gas vehicle fires, there's 55 fires per 1 billion kilometers driven, versus this data came from Tesla. There's 1 fire per 1 billion kilometers driven. So a fairly significant difference. And think of how many times you've seen a picture of an EV on fire, but in the US, there's about 150 gas vehicle fires per day. And you're obviously not seeing a lot of those. I think I'll leave it there. When we send out this presentation, I do talk about hybrid vehicles, natural gas vehicles, hydrogen fuel cell vehicles, and kind of why each of those options aren't nearly as good as fully electric vehicles, and where we are today with them. So I hope you enjoy that, and I certainly appreciate everyone coming in and listening today.
Amazing. Thank you so much, Mike. I know I learned a lot. I will also just let everyone know within the next day or two, I'll be sending out the recording of this, the slides, as well as Mike's awesome spreadsheet to everyone, to the email they signed up with. If you want to reach out to me by email, if you want to another email, just feel free to shoot me an email and I can send it to whatever email you prefer, but it will be going to the email you signed up to this with. So I'll just let you guys know. And of course, if you have any other questions for me or Mike, feel free to email us. But thank you very much for coming, everyone.
All right, thank you.